Welcome to Graph Insight. In today's episode, we're going to break down some of the most powerful price action techniques that even beginners can apply effectively. But before we begin, we need to understand the foundation. So let's clarify what price action actually means. Price action is a trading method that focuses purely on price movement. No indicators, no complicated formulas, no confusing settings. You simply study the chart itself. Now let's talk about supply and demand zones. Supply and demand are key areas on the chart where the market made strong, fast moves. A demand zone is a buy zone, an area of buying pressure. It forms at a level where price suddenly moved upward. This means buyers were much stronger than sellers, and when price returns to this level, buyers may step in again and cause a bounce. A supply zone is a sell zone, an area of selling pressure. It forms at a level where price sharply dropped. This means sellers overwhelm buyers, and when price revisits this area, sellers may become active again and push the market down. In simple terms, these zones are imbalance areas, places where big players move the market aggressively. Because of that, price often reacts there again in the future. So how do we identify supply and demand zones correctly? There are three key pillars you should follow. First, start with higher time frames. To accurately spot strong zones, begin your analysis on the daily, weekly, or even monthly chart. Zones formed on higher time frames are stronger, more reliable, and take priority over anything you see on your lower time frame. If you trade on the 1-hour chart, you simply won't see the major daily or weekly zones that control the bigger trend. Your actions on a lower time frame should always follow the direction of the stronger zones from the higher time frame. Second, look for trend reversal points. These are the areas where the trend changed direction, from uptrend to downtrend, or from downtrend to uptrend. Wherever a trend flipped, there was a surge of orders, either strong supply or strong demand, and these points often become powerful reaction zones. Third, focus on major levels of structure. A zone becomes a major structural level only if it meets three conditions. It has multiple rejections, it acted as both support and resistance, and it was recently respected by price. If a zone meets all three conditions, it's a strong one. Now let's move to the chart patterns, starting with reversal patterns. One of the most reliable reversal patterns is the head and shoulders. This pattern appears at the end of an uptrend and signals that buyers are losing momentum while sellers begin to take control. The market forms a left shoulder, a push up and a pullback. Then it creates the head, a stronger push making the highest point of the structure. Price pulls back again and forms the right shoulder, which fails to reach the height of the head. The pattern confirms only when price breaks the neckline that connects the pullback lows. This works because the head and shoulders represents buyer exhaustion. The first push-up is strong, the second push is even stronger, but the third push, the right shoulder, is noticeably weaker. That weakness shows that buyers can no longer move the market higher and sellers are stepping in. A break of the neckline confirms the reversal. To trade it, enter after the neckline break, ideally on a retest. Place your stop loss above the right shoulder and target the distance from the head down to the neckline or the next demand zone. Always wait for the neckline break. Without it, the reversal is not confirmed. Now let's look at two more popular reversal patterns, the double top and double bottom. A double top is a classic bearish reversal pattern that signals the market doesn't want to go higher. Price hits a resistance level and pulls back, then returns to the same level and gets rejected again. The reversal is confirmed when price breaks the neckline, the low between the two tops. This pattern works because buyers tried twice to break through that level and failed both times. Demand is weakening, sellers are stepping in, and the trend is ready to reverse. Entry is taken on the neckline break or the retest, with a stop loss above the second top, and take profit equal to the height of the pattern or the next demand zone. A double bottom is the opposite, a bullish reversal pattern. Price tests a support level and bounces, then returns to the same support and gets rejected upward again. The reversal confirms when price breaks the neckline above. You can enter on the breakout or retest with a stop loss below the second bottom and take profit equal to the pattern height or the next supply zone. Next, let's talk about continuation patterns, specifically the bullish and bearish flags. Flags are some of the most powerful continuation patterns in trending markets. They show a temporary pause inside a strong trend, a moment when the market takes a breath before continuing. A bullish flag forms after a strong, impulsive move upward, known as the flagpole. Price then makes a small, controlled pullback in a tight, downward-sloping channel. This is the flag. When price breaks out of that channel, the uptrend resumes. This works because the impulse shows strong buying power, while the pullback is simply profit-taking, not real selling pressure. To trade it, enter on the breakout and ideally on a retest. Place your stop loss below the pullback structure and target the height of the flagpole. A bearish flag follows the same logic but in the opposite direction. A strong drop, a small upward pullback channel, and a breakout downward that continues the trend. Finally, let's look at the pin bar, one of the cleanest single candle reversal signals. A pin bar has a very long wick, a very small body, and clearly shows where price tried to go, but was aggressively rejected. A bearish pin bar has a long upper wick, meaning sellers rejected higher prices. A bullish pin bar has a long lower wick, meaning buyers rejected lower prices. Pin bars work because they reveal pure market rejection. A long wick tells us the market attempted to move in one direction, but the opposite side stepped in with force. To trade pin bars, use them only at key levels such as supply zones, demand zones, or major support and resistance. Enter after the candle closes, place your stop loss behind the wick, and take profit at the nearest structure level. Pin bars inside random areas are weak, but pin bars at strong levels are extremely powerful. Before we finish, there is one more essential part of trading that every price action trader must follow: basic risk management. Risk management is what protects your capital and allows your strategy to work over the long term. The first rule is simple: never risk more than 1 to 2% of your account per trade. This keeps your account stable and prevents a single loss from becoming a major setback. The second principle is consistency. Use the same position sizing method on every trade, either a fixed percentage or a fixed dollar risk per trade. This keeps your results predictable and removes unnecessary variability. Next, aim for a minimum risk-to-reward ratio of 1 to 2 or higher. With solid price action setups, this ratio is realistic and gives you an edge even with a modest win rate. If you found value in this breakdown, make sure to like the video, subscribe to Graph Insight, and let me know in the comments which pattern you want me to cover next in full detail. Thank you for watching, and I'll see you in the next episode.